Hougan, President of ETF Analytics and Global Head of Editorial for IndexUniverse, and I'll be your host for today's webinar. I'm pleased to be joined today on the call by two of the true experts on ETFs, Dave Nadig, Director of Research here at IndexUniverse, and Joel Dickson, Principal and ETF Strategist for Vanguard. Dave and I have been putting together webinars for a long time, but this is, in my opinion, one of the best and one of the most important webinars we've ever delivered. ETF due diligence, making sure you understand how ETFs work, how they trade, and how they fit in your portfolio, is crucial to delivering solid results for your clients. We've heard countless stories of investors buying ETFs they thought did one thing, only to learn later that it did something else. And with the huge array of ETFs on the market today, understanding the strategies and separating the wheat from the chaff is more important than ever. The good thing is investors know this too. This webinar, despite its sort of dull title of ETF due diligence, is one of the best attended webinars we've ever done, suggesting there's real appetite for exactly this kind of information among your peers. The format of today's webinar is simple. For the first 40 minutes or so, Dave, Joel, and I are going to present a series of slides that cover the key things you should think of when conducting due diligence on an ETF. We'll give you a bullet point style list of 5 key things in 3 areas of the market that you should evaluate before you buy. Then, following the presentation, we'll have 20 minutes of audience Q&A where you can ask questions of us. As a participant in this webinar, you're invited to ask questions of me and my panelists using the Q&A tool at the bottom right part of your webinar browser. Please don't wait until the end of the webinar to ask questions. Ask them throughout the webinar as they occur to you. We'll collate the questions and answer as many as we can during the Q&A session at the end. We always get asked this, so I'll say it up front. A recorded version of this webinar, along with the slides, will be made available on IndexUniverse.com a few days from now. As a participant in this webinar, we will alert you by email when those are posted. Now, let's get started. Everyone around the industry loves to celebrate this slide. We use it at nearly every one of our presentations. The headline is simple. ETFs have exploded in recent years. There are now more than 1,400 ETFs on the market with nearly 1,000 additional funds in registration at the SEC. More than 100 new funds have launched this year alone, and we're on a record pace for launches. There's $1.3 trillion in assets. It's a boom time. The upside of all that innovation is clear. Investors have more choices covering more asset classes than ever before. Rising competition is forcing down prices, and we can build ever more sophisticated portfolios at ever more tiny costs. It's a beautiful thing. But like most beautiful things, there's a dark side, and it's this. The market is getting complicated. ETFs aren't just growing in number, they're becoming increasingly complex. Even within the equity class alone, issuers are pushing far beyond basic elements of size and style toward things like low volatility funds, quasi-active indexes, and sector rotation strategies. Investors have to ask themselves, what sector bets are embedded in the emerging or frontier market ETFs they're buying? What are the pros and cons of currency-hedged ETFs? Even among so-called plain vanilla cap-weighted funds, there's a big discrepancy and critical differences between seemingly similar funds. We run an ETF analytics service here that helps investors evaluate and compare ETFs, and it takes 11 people and millions of dollars in data and technology to do it right. But we do it, and we put on these webinars because we know it matters, more than some people think. Consider this example. This slide compares the performance of 7 U.S. utilities ETFs over the course of a single year. Utilities, of course, are theoretically the most boring segment of the U.S. investing universe, the widows and orphans, the plain Janes, the steady eddies. And yet, over the past year, the difference between the best and worst performing U.S. utilities ETF was 12%. Now, I'd hardly expect utilities to return 12%, much less for there to be a 12% dispersion among competing utilities products. Choosing the right ETF can help boost your returns, which drives asset growth and growth in your practice. Similarly, avoiding the wrong ETF helps too. Let's imagine that coming off the end of the 2009 recession, you made the call that natural gas prices were going to skyrocket. It was the call of the century. Prices had been plunging for a decade, and they turned around and rose 250%. Sure, they've pulled back, but they're still up about 75% over the past 3 years. The trouble was, what if you bought the most popular natural gas ETF to make that play, the United States Natural Gas ETF? It sounds good. It's got natural gas in the name. It even has United States, so it sounds patriotic. But actually, that fund's down about 70% over the same period. Your call was right, your ETF choice was wrong, and you ended up losing money. One thing advisors say to me when I point this out is, hey, look, Matt, what you say is true, but I run a fairly basic portfolio with broad asset classes and broad exposure, and I just buy plain vanilla funds from the big guys, the iShares, the Vanguards, the State Streets. Surely I can trust them, right? And to my mind, that brings to mind the old Ronald Reagan saying, trust but verify. This chart shows two ETFs, one from Vanguard, one from iShares, that until recently tracked the exact same index, the MSCI Emerging Markets Index. And over the period of this chart, these funds were trying to give investors identical exposure. But as you look over that 3-year period, you can see that the two funds are 9% apart because of how they were run and managed internally. Despite claiming to provide the exact same exposure, you were either up 9% or down that 9% for an allocation that could be a significant piece of your portfolio. The message is clear. You can't just trust people to look out for you. You have to do it yourself. I'll add that your due diligence on ETFs can't be superficial either. We know a lot of investors who will simply go to ETF issuer websites, download the fact sheets, and compare ETFs. That's a great first step. It's something I do a lot and used to do even a lot more. But unfortunately, it can lead you to false conclusions. For instance, if you were looking at energy funds right now and you were comparing the two biggest products out there, IYE and XLE, you would download these two fact sheets and you'd see that according to the iShares website, IYE had a price-to-earnings ratio of 15. And you might go to the Spider's website and you'd see that XLE had a price-to-earnings ratio of 10.9. You might think that was a big difference and that one had a strong value tilt. But really, it's just statistical noise. The problem is there are different ways to calculate PE ratios. You can cap negatives or not cap negatives. You can have bands or not. This is a screenshot from our ETF analytics service, and you can see that the PE on these two funds are not 15 and 10. They're not different. They're actually virtually identical. Now, this stuff is hard. To create this single number, we had to license the underlying data for more than 45,000 global securities so that we could do the bottoms-up analysis to arrive at this number. But you can see that it pays off. The message is clear. Bad data leads to bad decisions, and you need institutional caliber data to run an institutional caliber ETF due diligence program. So why does it matter? Put simply, choosing the right ETF can help you grow assets by giving your investors the portfolio they want, by helping you avoid mistakes, and giving you a point of competitive differentiation in the marketplace. The smartest institutions in the world spend millions of dollars evaluating and studying and selecting the right instruments for their portfolio. In the end, it's all about helping your clients meet their goals. Now, we get it. It's hard. Due diligence takes time. Our new ETF analytics service, as I said, takes 11 people, and it costs millions of dollars to build. But we know that it's valuable. That's why you're here today. Now, Dave and Joel and I, we're not going to demo the ETF analytics system today. What we're going to do is give you a framework you can use for evaluating ETF, for structuring a due diligence program on your own. We're going to talk about some of the questions you should be asking and some of the hidden risks that can pop up if you don't ask those questions. If you're interested in the analytics service, drop us an email and we'll sign you up for a free trial. But for the rest of this hour, we're going to help you prepare for tackling ETF due diligence on your own. Dave?
Thanks, Matt. So many of you have probably seen this framework before. We've talked about this. What we've done is taken the handy acronym of ETNF and reworded it into efficiency, tradability, and fit. And more than being a clever moniker here, this is how we actually approach every new fund, testing fund, every change that happens in the ETF landscape. We always consider it from these three things. Does the fund perform as promised? Does the fund trade at a fair price and regularly? And how well does the fund actually capture the market? That's the core of our framework. And what we're going to do is we're going to walk through each one of those and sort of point out the top 5 things that we ask our analysts to look at when they're evaluating a fund and that we think you should be looking at when you're trying to evaluate a fund. So let's dig right into efficiency, right? Efficiency is this core concept of how well is this fund actually delivering on its promise. So let's start with tracking. Now, most ETFs track an index, and the idea of measuring how well a given portfolio tracks a certain index is as old as indexing itself. People have been measuring this since the 1970s. Unfortunately, most people have been measuring it, in our opinion, wrong. This orange line here is the statistical tracking error of just a random fund we grabbed here. This is BKF, which is the iShares MSCI BRIC fund. And what that tracking error is, that what you're seeing bounce up and down around zero, that's the daily difference between what the index did and what the fund did. And as you can see, that number's a little bit up some days, a little bit down some days. Nothing wrong with measuring it that way, and indeed we look at that number too. The problem is it doesn't tell you all that much that's useful about this fund, right? If you take that standard deviation of daily return differences and you annualize it, you end up with, for this fund in this time period, a tracking error of 10.42%. Now, I don't know anybody can actually tell you what that 10.42% means. It certainly doesn't mean that you're expecting BKF to be off its index by 10.5% a year. That would be ludicrous. The fund would be out of business. Right? Instead, what it's telling you is that compared to other funds, this might be a high number or a low number, but we think it's kind of misleading and doesn't tell you all that much about your investments. So what we look at the tracking difference, and that looks at 12-month rolling windows of performance. The idea is if you are selling this fund today and you bought it a year ago, how did you do? And how did the index do? And you make that comparison. And then you go back a day and you do that. And you go back another day and you do that. And that's what gives you this blue line on this chart. And you'll see that in some periods you've done substantially worse than your index. In some periods you've done substantially better than the index. And more importantly, you can see that median number of being down about 60 basis points. That's your real expectation. In any holding period, you should be expecting this fund to trail its index by about 60 basis points. And as a reasonably expensive fund, that's not too bad. However, this minimum and maximum is pretty bad. That's something that I think most investors would look at and scratch their heads, right? And if you got this exactly wrong, wrong day and sold on the wrong day, you'd miss your index by almost 6%. Conversely, if you got it exactly right, you'd be up by 6%. Right? So that's the kind of tracking error we think people should be looking at. And it's not just in sort of out-of-the-way funds like this. To show how this traditional tracking error measurement sort of trips people up, I thought we'd look at two pretty traditional funds that have both been in the news a lot lately. This is Shares Emerging Markets Fund and the Vanguard Emerging Markets Fund, EM and BWO respectively. And a lot of investors I know with a Bloomberg on their desk will just go to the ETF page and they'll take a look at that tracking error number. And this is what it would tell you right now. You get about 60 basis points on the iShares fund and 4.4% on Vanguard Emerging Markets. Again, not numbers that are necessarily to tell you very much here. But if you look at it from this tracking difference perspective, this holding period perspective, you get a very, very different story. You'll see that the Vanguard fund has a much lower median trail to its index, and the range of expected outcomes, down 70 basis points to up 10 basis points, that's a pretty tight range, especially in something as complex as emerging markets. And you'll see that shows up at the bottom, too, in just these two snapshot periods of performance, right? The Vanguard fund has traditionally outperformed by a little bit over the slightly more expensive iShares fund. And it's actually tracked extremely well. But that traditional measure of tracking error would have led you very astray in making this analysis. So what's really going on here? What are the issues? Well, why does that Vanguard fund look like it's got this giant tracking error problem? Well, the reality is that calculating a fund's net asset value isn't as much a science as an that sounds a little weird to anybody who's ever dealt with accountants before, but there are a lot of decisions you have to make when you figure out how to calculate the net asset value of a fund. In the case of this Vanguard fund, we have a fair market value calculation, which is instead of using, say, the closing price of every South Korean stock in the fund, the value of those stocks are adjusted based on proxies here in the U.S., right? Because obviously South Korea is closed all day while EM and BWO are trading. So Vanguard, like many other fund issuers, chooses to fair value its net asset value so it's a better representation of the REIT at the end of the day. However, MSCI doesn't do that on the underlying index, so you get this giant disconnect. Over any meaningful holding period, that completely washes out, but on a day-to-day basis, it creates this illusion of giant swings in performance versus the index. Even in funds where that's not the case, there are all sorts of little issues that can crop up. We've got things like currency timing. You know, if you're a Brazilian fund, you have to do some currency calculation from the Brazilian real to the US dollar to roll up this number. However, there are a couple of different conventions about when to strike that currency price. Many people do it at 4 p.m. Greenwich Mean Time. Other people do it at 4 p.m. when the stock market closes here in the U.S. If the index provider and the issuer do it at different times, you're going to get this phantom problem between the NAV and what the index did. Now, Joel, I wanted to bring you in here. I had some thoughts here about, from the issuer's perspective, how you manage tracking and how tracking error can sort of creep in and whether or not it's important.
Yeah, so I would just add a couple of things, and you know, oftentimes this tracking error discussion, and certainly what we just talked about a moment ago, it tends to be around the net asset value of the fund. Yet another way to sort of look at this effect is by looking at the market prices of these ETFs and look how well they're tracking either each other or tracking during the course of the day or performing during the course of the day or over some period, because regardless of the pricing policies of different funds, you know, and you mentioned, Dave, the South Korea example, you know, South Korea may be closed, and if one fund has a fair value pricing approach, like Vanguard's funds do, then that may show up as a different NAV than another fund's pricing approach that doesn't use fair value prices, but the market prices of two ETFs, both of which that have South Korean stocks, are going to fair value price that in the market. That is, an investor in the U.S. is going to pay what they believe is the fair market value of the South Korean stocks in the market of the U.S., and in this case through the ETF. So that's another way to sort of get at some of these issues, although certainly the simpler way that you were talking about in terms of looking at the tracking is a great way to sort of try to deal with some of those issues as well with the 12-month roll. In terms of actually managing portfolios, this is where, you know, how tight you can track the index that you're managing against can come down to a number of different things, and the largest one tends to be whether you are fully replicating the index or optimizing to try to track the index. And I think it's instructive to realize that if you look at a prospectus for an ETF, an index-based ETF, it almost always says the investment objective is seeks to track the particular index. And the question is, how closely can you seek to track that? And, you know, the broader diversification, the more you can control the risk exposures, and often by replicating the index, if possible, that you can oftentimes get a closer track to the underlying benchmark. Now, sometimes that's not feasible if you have, for example, illiquids, you know, microcap stocks that would be very expensive to trade or not efficient to trade, each single one of them. Then you might try to optimize and match the overall characteristics on some level. But oftentimes when you see tracking differences, especially against very similar indexes of among different ETFs, it often comes down to how much you're replicating versus how much you're optimizing in that security, the underlying portfolio. There are some other things that can also affect that tracking difference, and one is about reinvestment of dividends. There are certain ETF structures where dividend reinvestment from the underlying securities, let's say, you know, the S&P 500, can be a little bit more difficult, whereas in other structures you might be able to use futures before you've received the dividends and the payable date to be able to fully generate the total return of the underlying index in the context of the portfolio, even if the dividends aren't paid for some period of time yet in terms of being received in cash by the fund. And then the decision around, if you're accessing international securities, whether you invest on local exchanges or, for example, through American Depository Receipts or ADRs, and how that can affect tracking as well. So a number of these things can certainly increase or decrease the efficiency in which you track the underlying index.
Right. Makes sense. Thanks for the insights. I mean, I think that helps to get the perspective of the fund manager in this as well. I wanted to move on to talk a little bit about expense ratios, and we're going to blow through a whole bunch of slides here because, you know, we have a lot of ground to cover. You know, one of the things that we always talk about is almost gospel with ETFs, importance of expense ratios, right? I mean, it's one of the few things you know in advance about what's going to go on with your ETF. And the problem is that often you're getting the wrong information even though you're looking in all the right places. So, in this case, we're looking at the expense ratios of 27 absolute return ETFs that are currently available in the market. This has been enveloped. This is funds that are charging, high fees but are competing with hedge funds that charge 2 and 20. So you expect the fees to be somewhat higher. And they range from about 40 basis points on the left all the way to a seemingly catastrophic, 3% over on the right-hand side. In other words, these are all high. The problem is they're not actually high enough, right? This chart shows the actual all-in fees for each funds if you dive into the prospectus and actually read everything. Now, I want to be really clear. It's not that the fund companies are hiding this information, right? It has to do with law and practice and how fees and expenses are shown when they're rolled up on these sort of levels. The way expense ratios are calced harkens back to an era that didn't consider the complications that something like an absolute return fund faced. So take an example of BTAH, which is one of the funds right here in the middle. It's the highest red bar on this. Now, it's an interesting little market-neutral ETF from QuantShares, and it has an interesting little fee of about 81 basis points. The problem, because this fund is taking short positions, there's a whole rash of expected dividends that will have to be paid out on those short positions that are considered an expense. Right? Most investors probably don't know about the negative impact of dividends. They think about it from the positive side, right? They look at the yield of a given portfolio, but they don't necessarily think about the expense of the short side. And there are other fees like this that pop up everywhere. There are hidden fees throughout the ETF world, and you really do need to dig in and read. I mean, there's even a series of ETNs right now that charge a weekly hedging fee that push its actual all-in annual expense ratio up to almost 5%. So, the story here is you really need to look under the hood. You can't just trust what's being cast as the top-line expense ratio. Even with a plain vanilla set of funds like REIT ETFs, you can have problems trying to get a sense of this all-in cost. So this is looking at the 8 big REIT ETFs. And we're looking here at the expense ratio and then the actual annualized tracking difference. And you'll notice here that the expected tracking difference should be negative, right? Your expected tracking difference should be equivalent to your expense ratio. Yet you'll see all these funds here on the left that have tracking differences that are actually better than their expense ratios. The reason for that are generally things like securities lending. So it's an interesting piece of the portfolio management puzzle that often doesn't show up. And then we'll get into this a little bit more when you add on something like spreads. This can change even more. We'll dig into this in detail when we start talking about trading. But it's important to layer these fees together, these expenses together, so that you can get a complete picture of what your holding period cost is going to be for any given investment that you're making. Right? This is what happens when you roll these things up for the round trip, your actual expense ratio versus the impact of your tracking difference being positive or negative and those round trip expenses. You obviously have very different sets of sort of true total costs here than the simple expense ratio calculation might lead you to believe. One last thing here I wanted to hit on efficiency was that of taxes. Now, two critical things on the tax side. One is I think many investors still approach ETFs as if they were just like stocks, right, and that they're going to get that same long-term maximum capital gains treatment of 15%, if they hold them long enough, or just like bonds, a bond fund. The problem is that many of the more interesting areas of the ETF space, that's simply not the case. You end up with big discrepancies between, say, a commodity ETF that's tracking futures by directly investing in those futures, where you have to play the blended 60-40 tax rate out to about 23%, and worse, you have to mark that portfolio to market every year, so you're going to pay taxes whether you sold or not, versus, say, a commodity exchange-traded note, which currently is still being treated as if it was an equity or a bond. It's going to be treated with that 15% long-term capital gains rate. Currency funds have much worse issues there. They're going to be treated as income pretty much regardless. And if you're holding something like GLD, which is investing in bullion, you're going to be paying 28% because it's a collect. Even though you can't take those share certificates and mount them on a wall, you're still going to get taxed as if you bought the bullion and stuck it in the vault. So real issues there. I think it's also worth pointing out the general issue of tax efficiency. Most folks know that ETFs are tax efficient. They've heard that, and that they often don't pay out capital gains for years. And I thought we'd have Joel sort of walk us through some of why that is and what you need to watch out for.
Yeah, and I think it's important to recognize that traditional mutual funds and most ETFs, at least those are structured as open-end investment companies and unit investment trusts, which is the vast majority of ETFs, have the same tax rules. So it's not that ETFs or traditional funds might be tax-free or tax-advantaged necessarily. They follow the same tax rules. However, with the ETF, one thing that has been made easier is this so-called process of in-kind redemptions, and that is typically when there is a redemption from the ETF, it is done in securities that underlie the portfolio as opposed to cash redemptions. And in that case, and what this graphic is meant to demonstrate is that is an opportunity to, if you will, optimize the portfolio from a tax standpoint. So what you can do then is if you have all these different securities, and think of the securities as being the sort of horizontal lines in terms of the number of securities that are in the portfolio, and you've bought these securities in the fund at probably many different price points. Think of all the times that you might buy ExxonMobil or Apple or so forth, and you have different prices for each of those lots. Now when you go to sell, and if you do it through an in-kind redemption, because the fund or the ETF will not have to recognize the gain that is done on an in-kind redemption for purposes of making capital gain distributions. You often select, and what you want to try to do is select the lowest cost lots, that is those with the most embedded capital gain, and you use those for in-kind redemptions, and that allows you sort of to wash away the realized gain within the portfolio. And so that's one mechanism that is made very easy in the ETF because it is only these so-called authorized participants that interact with the ETF, and they do so in large blocks of creation units, which facilitates the transfer of securities and therefore this in-kind redemption process. Now, if we contrast that to a normal redemption process, oftentimes in a traditional fund, or even if you're like rebalancing securities within the ETF, so it's not being done maybe through the in-kind process, but you're just selling for cash and either buying other securities or, let's say, funding redemptions if it's a traditional mutual fund. In that case, though, you're not going to select the lowest cost lot securities. You're going to select the highest cost lot securities and thereby maximize the loss or minimize the gain. And that's the way that you actually can see ETFs and traditional index funds, by the way, building up losses in the portfolios to increase the tax efficiency down the road in case there are periods where there might be gains that are realized through normal rebalances and so forth. That can mitigate the effect on the shareholder. So it's important to recognize that there is this sort of tax optimization that can go on based on the type of redemption or portfolio management activity that occurs. And certainly with the ETF that can use the in-kind redemption process, that gives it another avenue to use or to go down with the tax efficiency.
Right, and it's probably worth pointing out that are interested in this, that are investing in taxable accounts, sometimes it can be a bit difficult to figure out this current tax situation of an ETF. If you do dig into the semi-annual report, however, of a traditional 40 Act registered ETF, you can generally get a sense of whether there is a capital gains overhang on that portfolio or booked capital loss that they'll be able to use to offset gains later. So this information is there, but again, it requires digging into some of those filing documents to really understand it.
And it also, I would just add, Dave, that you can't just look at sort of the embedded capital gain in the portfolio, the sort of net capital gain exposure, because that reflects both gross unrealized losses and gross unrealized gain. And obviously the choice of tax lots, as we've just talked about in the last couple of slides, you're going to be choosing either gain or loss depending on the type of redemption that occurs. So that average number can be very misleading.
Got it. Super. Well, one last thing before I hand this back to Matt to talk about trading these things in the real world. A lot of gets made in ETFs and frankly in mutual funds as well about counterparty, certainly coming out of 2008. There was a lot of discussion about counterparty risk, people concerned about their securities lending activity, concerned about swaps or OTC derivatives in their portfolio. In general, we think most of the concern about counterparty risk in ETFs is hyperbole. Probably the only case we need to worry about it at all is in the case of exchange-traded notes. In exchange-traded notes, there is this counterparty risk, and it's entirely binary, right? The ETN is either going to deliver exactly what it says it's going to do, or if that ETN goes bankrupt and you end up, lined up with all the other Lehman shareholders to try to get pennies on the dollar. The reality is that because of that, ETNs should trade at a very slight discount. They have some slight additional risk that, say, in 40 Act mutual fund competing it wouldn't have. However, that's not the case. And the reason that that's not the case is that the actual risk is very low because these are intraday securities, right? Because of intraday liquidity, if you're holding one of these notes and you start becoming concerned, say, that Morgan Stanley is going to start creeping up on the risk scale, you have ample opportunities to sell on the open market in order to get rid of that risk off your portfolio. Because of that, we haven't seen ETNs trade at any real discount. If it is something you're concerned about, there is luckily a market for this risk, and it's the CDS market. And you can simply look up credit default swap rates for all of the issuers, and this is all the current issuers of exchange-traded notes in the market. And you can see that the market is effectively setting the level of risk for you. It's telling you that something that's the HSBC behind it is very, very low risk. Something with Morgan Stanley behind it is slightly higher risk. What this means is that you're being charged about 1% annually to insure a bond or a debt obligation from Morgan Stanley. Where we start getting nervous about these rates is when they start getting up towards 4 or 5%. So you can see in the current interest rate environment, in the current market environment, we believe that the counterparty risk on the ETNs is actually quite low, but it is something that investors really should understand, and if you're concerned about it, monitor it. Matt, I was going to take it back over to you to talk about trading.
Absolutely, yeah. I mean, I think if you think about what we covered in efficiency, it's really about the fund delivering on its core promise to you as an investor. We talked about tracking. We talked about tax efficiency. We talked about hidden risks like counterparty risk. The next thing you have to ask yourself is, can I access that pattern of returns at a fair cost? We call that tradability. An ETF may be the best thing in the world, but if you can't buy and sell it, it doesn't do you any good. And we think there are 5 key things you should know about ETF tradability, and I'll blow through those very quickly here. So the first is just bid-ask spreads, right? It's important to remember that ETFs are traded securities, and anytime you trade a security, there's a bid-ask spread. So just like a stock, an ETF share has 2 prices, one for buying and one for selling. And if you're buying ETF shares, you pay the ask price, and if you're selling, you receive the bid price. The difference between those two is the bid-ask spread. So in this simple example, the spread in dollars is $50 and a penny minus $49.99, or 2 cents. And to find it as a percentage, which is typically how bid-ask spreads are presented, you simply divide that amount by the bid-ask midpoint of the fund. In this case, it's 2 cents divided by $50, which equals 4 basis points. Pretty basic. You'll find that this number actually varies widely among ETFs. So this table shows the bid-ask spreads for 4 U.S. financial sector ETFs measured over a 2-month period at the tail end of last year. And we're showing the data here both in pennies and in percentages because you see both quoted in the media. Now, pennies are a nice intuitive way to consider spreads, but actually we recommend looking at the percents because they take into account the fund's share price. So RWW's 7-cent spread may look bigger than PFI's 6-cent spread here, but in fact RWW's spread is tighter because it has a higher share price. The same is true actually for IYF versus XLF. Despite the fact that XLF trades at the minimum possible spread of a penny a share, it's a bigger percentage of the portfolio than IYF's 2 cents a share. Obviously, the tighter the spread, the lower the costs, the better off you are. And the impact of these costs can be significant. So this chart shows the cost of the bid-ask spread added to the expense ratio for a 1-year round-trip holding period. We've seen a huge amount of concern in the press recently about what amount to very small differences in expense ratios. And you can see here if your holding period is rather short, the bid-ask spread can overwhelm these costs, right? IYF and RWW have similar expense ratios, for instance, but once the spread costs are considered, considered, the costs are nowhere near equal. In the case of funds like RWW, the spreads can be half of the expense ratio or more. Of course, if you plan to hold these ETFs forever, those spreads get spread out over many years, and you have to take that into account. But still, spread is an important thing to consider.
Hey, Matt, I would just add that distinction is really important, and it's something that we see all the time that folks get confused on, is they just want to add the bid-ask spread to the expense ratio and come up with a total cost figure. But as you've positioned it appropriately, that assumes a 1-year round-trip holding period. If your holding period is shorter or longer, the shorter it is, the more the bid-ask spread matters. The longer it is, the more the ongoing expense ratio matters.
I think that's a huge and great point. And one thing I think investors want to do is they want to say that, you know, this particular ETF is the best ETF for everybody. And I think what you said is exactly right. You have to match your holding period with your priorities on the spread versus the expense ratio. And the longer you're going to hold that security, the more that expense ratio matters. So I think it's a huge point. And I'd also say, you know, depending on which security you're looking at, we like to look at bid-ask spreads over periods of time. So this looks at the daily bid-ask spread for 8 financials ETFs over a 1-year period. And you can see that for some ETFs, the spread can be quite dynamic. So we actually think focusing on that average spread number is a good first step, but we like to dig deeper and look over periods of time. If you look at the spiky line on that chart, that's XLFS, you can see that the spread on that spiked out to about 1% during what was the flash crash there in May, and it took a long time for that spread to come back in for small cap securities. Other ETFs, the spreads reverted more quickly. But just a word of caution on average spreads, even if you are focused on that number, look at it over time and not just as a single data point, because it can be somewhat misleading. We also get asked quite often, you know, when should I trade ETFs? And the answer is basically, you know, any time but the open or close. This chart compares the weighted average spread of the underlying holdings of IVG, a big software ETF, to the spread of the ETF itself. And you can see a few interesting things here. You know, first I'd note that the ETF spread is actually tighter than the combined spreads of the underlying securities. That's the case in a lot of ETFs these days, particularly emerging market ETFs, where the ETF is vastly more liquid than the securities it holds. And second, you'd see that the spread is the widest right at the beginning of the day. That's because not all the underlying securities are trading at that time, and those that are, the spreads are widened out. So you can see that in the orange line. You're still better off in this case in the ETF than you are in the single stocks, but you do see more volatility around that opening spread. Yeah, you see a similar pattern actually in international securities based on when the underlying market is open. One question we get is how you know an ETF is trading at fair value. And the answer for domestic equity stocks, I think most people know, is to look at the INAV. INAV is a value that all ETFs issuers are required to publish every 15 seconds of every trading day, which essentially shows the average, the net asset value of the underlying portfolio. And that works great for, you know, a fund covering the U.S. market. But the problem with INAV is that for something like a Japan ETF, if you look at that chart at the bottom of this screen, the underlying securities don't trade during New York market hours. And as a result, the INAV won't move except for to account for currency adjustments. So you can get INAVs that are completely misleading for international securities. We love to show this chart. This is a chart of GXC, a China ETF. The actual share price of that ETF is in blue, and the INAV is there in orange. And you can see that the INAV is marked by a series of overnight jumps where the value readjusts based on whatever trading happened in China. And all of those premiums and discounts are artificial. I would note that there are, I think, 2 or 3 days there. You can see that big, more or less flat period for the INAV. That's actually the Year of the Dragon holiday in China when the local Chinese markets were closed for a couple of days. And anyone who is looking at the premium discount here got false information. So it's just a fair warning to pay, you know, take premium and discount information with a grain of salt as you move into the international space. One thing to concern yourself with, another thing is the liquidity of the underlying securities. The old saying goes that an ETF is only as liquid as its underlying securities. Here are 4 broad-based emerging markets index ETFs, from the big Vanguard broad-based fund at the top to an itty-bitty small-cap emerging markets fund at the bottom. And that statistic on the right-hand side is one of the stats we calculate for our analytics service, which essentially asks, what percentage of the ADV of the underlying securities would you have to buy to create a full basket of these shares? And you can see that for a fund like VWO, the underlying securities are extraordinarily liquid, and that fund should trade at tight spreads, even at enormous size. For a fund like the emerging market small cap securities, to create a basket of that, you have to move, on average, almost 4% of the ADV of the underlying securities. That's starting to be significant, and you would worry about that fund's spread widening out and there being significant market impact if you were buying large chunks of that security. One final thing about premiums and discounts to worry about, we mostly worry about them when there's structural issues with the underlying market. So we showed that there's no really good way to compare GXC to its INAV during the day, and that's true generally for most international securities. But if they're liquid, you can generally count on them to keep prices in line. Where that breaks down, again, is a situation like this. This is the EGPT, Egypt ETF, during the Egyptian Revolution, when the Egyptian Stock Exchange closed for a period of time. And you can see that it spiked to a premium almost immediately, traded up almost to a 30% premium, and then when the Egyptian market reopened in March, all that premium disappeared. You can see a similar thing here with TVIX. This is a famous example. A Credit Suisse closed creations for their popular volatility ETN TVIX, and the fund actually traded to 100% premium. Anyone who bought at that top premium level lost half their money in a period of 2 days when Credit Suisse reopened the note for creations. So the big issue on premiums and discounts is make sure that the underlying markets are open, liquid, and functioning to allow that arbitrage process to take place, or else you can get significantly hurt. Joel, I know you had some thoughts on how to go about placing orders and getting best execution from an issuer's perspective. Hoping you could share those.
Yeah, and in many ways, this just, Matt, summarizes exactly what you had just talked about, which is, when you're thinking about trading ETFs and placing orders, there are certain periods where you want to be careful around the market open, around the market close. If there's volatile markets intraday, oftentimes you may see some premiums or discounts as sort of that arbitrage mechanism is working. But with more volatile markets, that in and of itself can be a little bit more volatile. So looking at the INAV, especially in those cases where it's appropriate, is important. And then, when there is this non-synchronous trading that Matt, you talked about around different markets open at different periods, then the market value, if you will, on the U.S. exchange, for example, is going to be trying to fair value those assets. And in fact, we saw that in 2008 and again in 2010 on the bond market side, even though they might have been U.S. bonds, when liquidity dried up in the fixed income primary market, what we saw were the fixed income ETFs were still trading, albeit with a lot of volatility, and trying to figure out whether it was a fair price or not got to be very difficult. But in many ways, you could look at the ETF as actually providing the price discovery of the underlying portfolio of securities in that case. In terms of international ETFs, we say, if you're trading a European based portfolio in terms of a U.S. ETF, then you might consider doing it before 1 o'clock when there's more markets that are open, more overlap, and therefore a little bit more liquidity in the underlyings. But ultimately, anytime you have some mismatch between the open in the U.S. and the underlying securities, you're going to have this large market swing potential due to fair value pricing. One thing that was just on the previous slide that is important to touch on is we often have a saying, which is to say, friends don't let friends use market orders. And and this is where you have to be careful with trading ETFs, because this basket of securities, that you don't want to go through the depth of the market or the depth of the book, that is sort of where the bid and offers currently are structured in the marketplace. And one way to protect yourself from that, especially in less liquid ETFs, but I would say this is a best practice across all ETFs, is to use what we would call a marketable limit order. So use a limit order to protect yourself from a sharp movement due to just going through the shares that are currently quoted. But with a marketable limit order, so for example, if you're buying, you might put an order in a couple of pennies above the ask price, or if you're selling, a couple of pennies below the bid price. So if something were to happen and it runs away from you, you're protected, but at the same time, you're within the market bid-ask spreads and are likely to get executed in those cases. But it can be really dangerous to use market orders or even stop orders for ETFs, because once that stop limit is breached, it becomes a market order. So marketable limit orders or even straight out limit orders we think provide a little bit more protection.
Super, super. So I just want to make one quick housekeeping note here. We're probably going to run 5 or 10 minutes late here so that we can have a chance to take some questions. I'm going to whip through a few final slides here to talk about fit and index selection, and then we'll open it up for questions. When we talk about fit, really what we're talking about is getting you the exposure you think you want, right? So that means that if you're looking at, say, large cap, you're choosing between 10 funds that are in the large cap equity space, picking a fund that actually gives you that exposure, right? Funds can be enormously efficient and highly tradable, but if they're holding something you don't think they're holding, or they're not providing exposure to a sector you think you're getting exposure to, none of that matters. So I wanted to just talk about a few ways you can make sure you don't end up in that trap. One of the first things really to think about what indexes do when they're combined together. Very few investors invest in a single ETF and then call it a day. These are almost always a part of a portfolio. And a thing to really watch out for is sort of accidental overlap, right? Many people might not know, for instance, that in some quote-unquote large cap index, it's actually the same thing as the combination of a mega cap index and their mid cap index. And so if you don't dig in under the hood and look at what these funds actually hold, you might, for instance, decide you want to sort of create a everything but small cap portfolio and buy both the low index fund and the mid cap index fund. And what you actually will have done in this particular case is double up on your mid cap exposure, which might not be what you wanted to do. Another problem you can run into is if, for instance, you're trying to get sector exposure using sector ETFs and you pick from different families. So you might buy, say, a consumer services ETF and then a consumer staples ETF, realizing that depending on the classification system, you may have actually made Walmart the #1 holding in both of those purchases. Right? Those kinds of overlaps, while not necessarily bad, are things that you need to know going in. Maybe you meant to double up on your Walmart exposure, but most likely you probably didn't. Even if you're looking just inside the same pool of securities, there are enormous differences between indexes. These are 6 very popular large cap U.S. equity ETFs, right? SPY up here at the top, the spider being at the default in this case. And I think nobody would be surprised by the stats here, $120 billion average market cap, 16 PE, et cetera. And if you look at the other funds here, you've got things like the revenue shares, RWL, fishing from the same 500s, but getting a lower PE version of the same stocks. You go down to something like RSP, and you're looking at an equal weight version, which is taking all of the exposure of the S&P 500 and slicing it up evenly. So the smallest stock in the ETF has got the same weight as Apple. You end up with RADA portfolios. Or even down at the bottom, the new kid on the block, SPLV, this is looking at the S&P 500 and picking only the lowest volatility stocks out of that. If you're foregoing companies like Apple entirely, which most people would recognize as being pretty volatile, and you're also completely skipping the financial sector. So we have 6 funds all purporting to provide large cap exposure, all with vastly different portfolios. I would say in most segments of the market, this is actually the norm, not the exception. a couple of ways that you can really have your portfolio accidentally skewed if you don't look under the hood before you invest. Let's imagine you were going after the BRIC space, Brazil, Russia, India, and China. Here are 3 funds competing in that market with radically different takes on it. If you want Russian exposure, well, you better go into BIK. It's got 27%, more than even our benchmark. You better avoid EEB. Now, it's not because the portfolio manager at the Guggenheim BRIC Fund, EEB, hates Russia. The index construction for that requires only ADRs, and there just aren't that many Russian ADRs for him to choose from. So hence he ends up with a note that's radically overweight in China and Brazil and skimps on India and Russia. It's, again, active management decision, but in your portfolio, it's going to show up like one whether you intended it to or not. And then there's sector exposure. Personally, I think sector exposure in the modern global economy is probably one of the biggest determinants of your equity returns. And I know a lot of advisors agree with me, and they put in place sector rotation strategies, either from a technical perspective or from a fundamental macro opinion perspective, where getting purity in the fit realm can actually be really important. So I just literally grabbed this one at random. This is PBE, a Power Shares Dynamic Biotech Fund. It's been a great fund for some investors. It's up 22.5 this year, but it's not a biotech pure play. It's full of equipment companies. Now that's fine if your premise here is that you want sort of a broader healthcare innovation play, but it's certainly not a pure biomedical research fund where you're expecting those sort of hedge fund-like private equity returns to come out of the biotech space. And virtually every corner of the market is like this. I mean, if you want utilities, you better have an opinion about AT, because half the utilities ETFs have huge weights in it, and the other half skip it entirely. Another thing that I think a lot of investors don't look deep enough into is the issue of concentration risk, and I really think of this as blow-up risk. Right? I think of this as, well, what if one stock blows up, and how much is that going to hurt me? A traditional way of looking at it is this stat in the middle here, which is the total in 10. You see that used all over the place, the percentage weight in the top 10 holdings. Well, here we have 2 Russia funds with pretty similar weight in the top 10, and you'd actually sort of think that RSX on the right, with 57% in the top 10 holdings, is sort of the more concentrated fund. In fact, however, that belies the fact that, again, just because of the index construction differences between these 2 funds, Gazprom's almost 20% under RBL. I consider that a higher blow-up risk, and I think many investors would shy away from that. Now, sometimes that's exactly what you want. If you want to be tentative of the actual market, sometimes particularly in emerging markets, you end up with a few companies with enormous weights. You need to know that going in. The stat here at the bottom is the one we use internally to calculate that. It's called the Herfindahl or Herfindahl ratio, and higher numbers mean higher concentration. And again, this is a simple calculation. You can run an Excel spreadsheet against the weighting of any ETF that you might pull down. But again, I think most investors look at this top 10 list and don't dig any further. And then one last point I want to make, which is just the whole issue of chasing performance ETFs. One of the things that we do internally is we analyze every ETF versus a neutral benchmark to see whether or not it's generating statistically significant alpha. Not just whether it outperformed over a year, but whether from an academic finance perspective, there really is a better mousetrap. And ones that seemingly have these outperformance years look like this, right? This is the Power Shares Dynamic Basic Materials Fund, which is effectively a quant active approach, versus the Vanguard Materials Fund, which is a pretty plain vanilla indexing approach to the same space. And in this one period here, we see a pretty traditional, right? The pattern looks very much identical, except you have higher returns on the upside. The problem is that this is almost always what it looks like in a downside. You end up with the fund underperforming with the same basic patterns as soon as the market turns down. This isn't alpha. This isn't a better mousetrap. This is beta manipulation. This is simply a higher beta version of the exact same set of stocks, the exact same index that you're going after. And there's nothing wrong with this, but you need to understand that you're making a high beta play, not necessarily buying a better mousetrap when you find a fund like this. You can achieve this same pattern of returns effectively just by buying a little bit more of the less expensive vanilla version on margin, and you'd still end up with a higher beta play, a little more money on the upside, a little more money on the downside. So mostly I wanted to put that out there as a kind of word of caution before you start trying to chase performance purely on the basis of, say, how a fund did last year or whether or not it had 5 stars, which our Shares Dynamic Basic Materials did. Joel, I wanted to give you an opportunity to sort of wrap this up for us and talk a little bit about the sort of index selection process.
Yeah, and I'm gonna blow through this fairly quickly, so we'll have some hopefully have some time for some questions. But basically, one of the things that we have seen with the huge growth of the ETF industry and the number of ETFs has also been a huge growth in the indexing business in terms of number of indexes. I mean, our calculations at Vanguard, with the more than 1,400 ETFs that are out there today, track actually about 1,000 indexes, and so there's been this big boom in terms of index creation, index selection. And when we're thinking about this from an index standpoint in terms of tracking for an ETF or for a traditional index fund in our case as well, what we are looking for are a series of best practices around, do they reflect the markets that you're trying to target? Is it clearly defined in terms of the market segmentation? This would be like caps, large, small, mid. Is it clear? Is it understandable? Does it reflect the investment style? And this often comes up in things like growth and value. Does it reflect what sort of traditional managers would consider to be a growth stock or a value stock, and your index should do that as well. And then do you have a basically an investable index? That is it constructed in a timely and efficient way so that you can actually track it in real time in a portfolio? And what I would say is that over the course of the last decade especially, but even more the case for broad market type of portfolios, whether it be broad bond market, broad equity, broad international, there has been a convergence to this series of best practices among major index providers, and generally what you get on broad market sort of betas, if you will, are very similar risk exposures. So you can see that in this chart here. I mean, regardless of whether the market's going way up or way down, these broad market representations, regardless of the indexing brand, tend to provide very similar exposures over time. And if we go to the next slide, one of the debates that has come up is whether the sort of traditional cap-weighted index approach, in fact, is providing the same or providing a different kind of exposure than some of these newer indexes that are being created that are calling into question, and in some way, the cap-weighted approach. And usually it's that there's some subset of factors that somebody identifies as maybe being better or wanting to have exposure to, like dividends or assets or cash flow, and the argument being that cap weighting is overweighting the overvalued stocks and underweighting the undervalued, and if you look more at fundamental characteristics, you might be able to build a better mousetrap. However, a cap-weighted index actually does take those factors into account, as well as every other factor that an investor might talk about or consider in the evaluation of securities. And in fact, that cap-weighted approach, the market price, is reflecting the consensus opinion of all investors in the market using all factors. When you start getting into different indexes, and different index construction that's been occurring, what you start seeing then are maybe changes in risk factors. And if we could advance the slide here, what you see often with a lot of the fundamental indexes is it a better mousetrap, or are we just reweighting risk exposures? So this is sort of the traditional Fama French type of framework where you have a market exposure, a small cap exposure, and a value exposure. And you can see that a lot of sort of the more popular fundamental indexes relative to the broad-based capitalization indexes tend to overweight a little bit on the small cap and a lot on the value exposure. And you can replicate those exposures yourselves using the broad array of ETFs that are available. If you wanted to overweight value, you can use a value-based ETF or a small cap-based ETF. So when we evaluate some of these fundamental indexes, and much like Dave was just talking about in terms of trying to sense true alpha, if you will, or and consistency, is after adjusting for these risk exposures of value and small cap, what are you left with? And so here, lines above the zero value would be where there is some alpha. Lines below would be negative alpha. After adjusting for these risk factors. And as you can see, once you adjust for the value and the small exposure, it's not so clear that there is a consistent alpha, if you will, that couldn't be captured just by simply investing in ETFs that might target those risk factors more directly.
I think that's a great point. What is sure is they tend to launch after periods when those risk factors have been performing well.
We did some research on that over the summer, and it's amazing how new indexes are being constructed more through the rearview mirror than actually a forward-looking perspective.
Yeah, it's shocking. You don't see many underperforming back tests out there. It's all the kids are better than average. We did take up a good bout of time going through those slides, but it's a big topic. We're going to run this webinar through another 10 minutes to get through some Q&A. And Joel, I wanted to go back to some of the stuff we covered in the very beginning. We've gotten a lot of questions from the audience about the question of replication versus optimization. And I guess I would ask you two related questions. So first, does it cost more to fully replicate an index? And second, are there any knock-on effects on the liquidity of the ETF itself by engaging in full replication versus optimization?
In terms of the cost piece, usually when people will talk about replication and optimization, the cost discussion tends to be the trade-off of potential tracking error. That is, the more fully you replicate the index, for the most part, you're probably going to have a lower tracking error. But the cost being potential increased ticket charges if, in fact, you are trading every security in small numbers, sort of the custody charges that result from it. But there are very simple ways to deal with replication and filling in around the securities and every day. And in an ETF, that's especially true because most often your creation basket is a full slice of the underlying portfolio. And so the replication in that case is very easy. And in fact, the bigger or the more replicated the basket is relative to the underlying portfolio, the less sort of filling in you have to do, and it keeps tracking very, very easy and straightforward. I like to talk about this replication versus optimization question as the debate that comes up all the time when people are doing, for example, the U.S. Census. And it's like, do you have to actually go out and see everyone, or can you sample statistically and try to get a result? And by and large, what people have said is, well, the more that you can replicate, the more that you can get to everyone, the better confidence you have in the result. And that's the way that we think about, at least at Vanguard, in terms of building portfolios, is to the extent we can get the broadest diversification, most replication, and so forth, that limits the risk, and we can do it in a cost-effective way. Matt, in terms of the knock-on effects, anything in particular that's coming in the question?
Well, just, our fully replicated indexes, does that translate into a basket that's harder for APs to trade, and are there concerns there?
So historically, there had been at times, well, and still happens today, some baskets that get created based on liquidity as opposed to replication, and in fact, that's often done in fixed income ETFs, and that's a matter of, again, how close you can get while minimizing the tracking error, but trading off the liquidity of the basket, and it's certainly a consideration when you're building the ETF and how you track and so forth. So it's certainly a consideration, but any portfolio manager, any ETF process is going to try to make that trade-off to minimize the tracking error and then use other securities to fill in those gaps. So, for example, with a mutual fund and an ETF share class like Vanguard's funds are structured, you can use cash flow from the traditional mutual fund side to help fill in any gaps that might be occurring from any shortcoming in full replication that comes from the basket. So you can trade these off pretty easily.
Joel, we have had a couple of questions specifically about fixed income. A few folks have pointed out quite accurately we used a lot of equity funds in a lot of our descriptions here. You mentioned sort of one difference there, which is sometimes these indexes for fixed income securities are enormous. They have thousands of securities in them. Obviously, you can't put that all in the basket. Are there any other things that you think investors need to pay extra special attention to when they're comparing fixed income funds?
Yeah, there's a pricing difference in how the funds and NAV and the ETF is traded that I think is important to understand, because for the most part, fixed income funds look like they trade at a sort of regular and sometimes significant premium to the net asset value. It's important to understand, however, obviously, if you're an investor and you buy at a premium and you sell at that same premium, then you're net no different. So if it's a consistent premium, it's not usually a big issue for somebody trading the ETFs. But this is a result of the way that fixed income funds are required to price their net asset value, which is that you have to use the bid prices of the underlying fixed income securities. But yet when you're trading in sort of the market as a whole, if you're buying, you're going to buy those underlying securities closer to the ask. So if there's a lot of sort of buy pressure in the marketplace for a fixed income ETF, probably what's happening is it's trading closer to the ask, but yet it's the net asset value of the underlying securities is still being calculated using bid prices. So it's going to look like a premium since the ask is bigger than the bid. But again, that's one where over time, if it's a consistent premium, it doesn't hurt you. And this is certainly the case with like Egypt or TVIX that you showed earlier. It's the volatility of the premium that can really cause trouble.
Yeah, I think that makes sense and is what people should be worried about. Now we have a webinar coming on about this next week, Joel, but we've gotten some questions from the audience about emerging markets and selecting an emerging markets benchmark, and particularly around the question of Korea and its role. What would be your general advice to investors when looking at the emerging market space? What should they be looking for? How can they make that decision?
Yeah, so the emerging market question, it's funny because different providers have somewhat different definitions of emerging. Generally, people are trying to get a risk exposure that is such that you're trying to capture the smaller, faster growing, in many cases, sort of not fully developed markets, and in many ways people are trying to capture either some version of a liquidity premium or a risk premium that might be available from those emerging markets, obviously taking on extra risk in doing so. And there are always migrations and definitional differences of developed and emerging markets. I mean, you think about Israel having graduated from emerging to developed several years ago. And Korea right now, from what we see in terms of how different index providers are treating it, is one that is in transition. Some index providers consider it developed, some consider it emerging. We certainly think that when you're building an international equity portfolio, you're trying to get broad-based representation. So you want Korea, and oh, by the way, you want Canada too, which many portfolios that would combine a developed market strategy often don't have, in addition to an emerging market strategy. So I think it's important to recognize where the gaps are in the country allocations and, make sure that you do have that exposure to it. And, that the Korea one is just sort of the latest one that people will consider. But as we've been thinking about it from the context of a transition of our emerging market portfolio, where Korea will be removed from the emerging markets portfolio over the course of the first half of 2013, it's to us, the 13th largest economy and growing and so forth, it certainly has acted a lot more like a developed market, and in many ways we can control the transition in a much better way and mitigate the transaction costs relative to if it was all being moved on somebody else's schedule in one big trade.
Right. So we're coming close to running out of time here. I wanted to ask you one more question. Sorry, we've kind of put you on the hot spot here. But we blew through some of the stuff on counterparty risk. We had a couple questions about securities lending. And so maybe just like a one-minute answer, should investors be concerned about securities lending inside their ETFs, and how can they even assess whether it's an issue, positive or negative for them?
So securities lending did get some play during sort of the financial crisis, but what I don't think was fully understood was it was not so much the securities lending process itself, it's how the collateral that was received that backs the security lending was invested that caused some problems. And so there's sort of three parts of a securities lending program. One is what securities you lend, how you invest the collateral in that lending process, and really sort of how much safety or margin or collateral you have. And generally in the U.S., you're mandated to collect collateral that is in excess of the risk exposure from the securities lending process. And if you invest that in high quality, cash-like instruments, there's very, very little counterparty risk that results from that process, because it is more than fully collateralized on a daily basis.
Yeah, I think that's a critical point. People always ask me, and I always say, I own ETFs. I want people to be doing securities lending. If they're a well-managed program, the benefits outweigh the risks in my mind.
The only thing I would say to that, too, is that it matters how much the shareholder is taking all of the risk, to the extent there is some. And, in our opinion, they should also get all of the securities lending revenue back in return, and that's not always the case.
I couldn't agree more, and that's a statistic we do highlight on our analytics reports. You are bearing the risk, and if you're bearing the risk, you should get the reward. With that, we've taken up a full 70 minutes of everyone's time. I'd like to thank Dave and Joel. I think this has been a great webinar. The slides, as I mentioned earlier, will be available on the IndexUniverse website within 2 days. You'll be receiving an email as an attendee of this webinar with a link to those slides, as well as information on how to claim your continuing education credits. We're actually going to have Joel back here next week for another expert series webinar entitled FTSE versus MSCI, Vanguard Switch, and what it means for investors. I think it's going to be a great webinar about a hot topic in the ETF space, so please register for that as well. Thanks again, Joel, and thanks again, Dave, and thanks to you, the audience, for tuning in. Hope you enjoyed it. We'll see you back here in 1 week. Have a good afternoon.